With the allowance method, we have to come up with an estimate for how much we're not going to collect. And businesses use 3 different methods usually. There's probably more out there, but businesses usually use one of 3 methods to make this estimate. I want to emphasize we do not have to use any of these methods with the direct write-off method because there is no estimation when we are directly writing off accounts. We just wait until we finally give up and say, all right, that's when our expense is. Under the allowance method, though, we need to make estimates, and that's where this comes into play. How do we make that estimate? So here's an example for using the percent of sales method. Percent of sales method is we look at the sales that we've made, and specifically, we have to look at credit sales because why not cash sales? Well, cash sales have nothing to do with bad debt expense. There's never any bad debt expense with a cash sale. Our customers already paid us. So if possible, we need to separate our cash sales from our credit sales and then just look at the credit sales. If you're doing a homework problem, you'll want to read specifically if they have credit sales for you. Just don't include the cash sales in your calculations. In this example, let's say we made $700,000 in credit sales. So let's just make that journal entry just for the practice. We had accounts receivable of $700,000 and sales revenue of $700,000. All right, and at the end of the year, we say, all right, we need to make a guess as to the bad debt expense. The reason we need to do that is we need the sales revenue and its related bad debt expense on the same income statement. So we need to come up with a number to put there. And then we put that in the allowance for doubtful accounts because we don't know who yet. Until we know who, we need to leave it in the allowance. All right, so our question is, how much do we put there? Percent of sales is pretty simple. We just say, all right, what were our credit sales? In this case, 700,000. Multiply it by whatever percentage we come up with. This is usually based on our experience. And we say, all right, well, that equals $10,500. We're just going to use that number directly in the journal entry. That is our bad debt expense. This is often called the income statement approach because we are looking at the income statement to get all of our numbers. We looked at the income statement to get the sales number. So we said it's 1.5% of our sales. And then we directly calculated what was the bad debt expense. So the number we came up with was our bad debt expense. Usually we can just directly put that into the journal entry. We don't have to do any other calculations. We just say, that's our journal entry. All right, so this is the easiest method, but it also causes some problems, just like all of our other easy ways of doing things. There's some issues with it. Let's see what the issue is. Let's look at our allowance for doubtful accounts. Right now, we put $10,500 into it. Let's jump forward to next year. Let's say that we underestimated how much our bad debt expense was. So, for example, we guessed that we wouldn't collect $10,500, but we had a bad year, and at least our collections department had a bad year, and we missed out on $15,000. So the journal entry that was made when we wrote off $15,000 of accounts was allowance for doubtful accounts, $15,000, various accounts receivable dash, Dave or whatever, lots of people, $15,000. So we debited allowance for doubtful accounts $15,000. That leaves us a $4,500 balance in the allowance. Now, a debit balance in the allowance doesn't make a whole lot of sense because that would be like a negative contra account, which doesn't make any sense at all. So now usually this would be fixed at year end. So let's say next year we get down to the end of the year and we say, all right, we made $900,000 in sales. Made $900,000 in sales, and well, last year it looks like we should have done 2% instead of 1.5%. So let's fix that going forward. We have bad debt expense of $18,000 and allowance for doubtful accounts of $18,000. That means I'm putting that over here. And now my bad debt expense is correct. It was incorrect last year, but it's correct this year. The problem is the allowance for doubtful accounts is always going to be incorrect. It accumulates all of our mistakes year after year. So we end up with, what, 13,500 in here. And so why is that a problem? Bad debt expense gets flushed out every year. So during the closing process, if you remember back to chapter 4, the closing process sets all of our revenues and expenses to 0. So if we make a mistake in bad debt expense, it only affects 1 year. So all right, we make a mistake, it gets flushed back to 0. It just affected that one income statement, and we'll correct it going forward. That happens all the time. So we make mistakes on the income statement. We make bad estimates. It happens a lot. But it usually only affects 1 year. Because, if we made a mistake on an expense, next year we'll do better. And last year's mistake does not affect this year's mistake. If we make a mistake on the balance sheet and we don't fix it, in this case, we made a mistake. We put not enough in the allowance for doubtful accounts. Guess what? That mistake follows us forever. That $4,500 debit is going to be there affecting our account forever because we don't reset balance sheet accounts in the closing process. So that is one of the main issues here with the percent of sales or the income statement approach is we can end up with some really weird numbers in the allowance for doubtful accounts because if we make a mistake, it just follows us forever. All right, so that is one of the big disadvantages. One of the advantages of this approach is it really follows the matching principle. In spirit, if we did everything correctly, the matching principle says match revenues with expenses. That is exactly what we're doing. We're using our revenues to calculate the expenses, and it is a beautiful thing when we're trying to follow the matching principle. But it can cause some issues on the balance sheet. So in short, percent of sales method, we take the credit sales, multiply it by our percentage that we've come up with based on our experience. That is our bad debt expense. That's what goes in the journal entry. It's simple, it's easy, but it can cause some issues on our balance sheet going forward. So in the next video, we're going to look at the method that can fix our balance sheet. It does cause some issues with our income statement, but it fixes this balance sheet problem that we have.